Everyone is talking about Palantir. The stock is hot. The story sounds amazing. And people are saying it will continue to be the next big thing. Here's the deal. If you don't know what it's worth, you're just guessing. You're just chasing a ticker up and down. In this video, I'm going to show you how to determine the price that makes Palantir a great investment and explain it in a way that anyone can understand. Let's break this down together. All right, let's be honest. Everyone has fun trying to figure out and find the next hot stock. Everyone wants to say, I called it before it took off. And trust me, I love doing that. The thrill, it's real. But here's the thing that most people don't understand. Just because a stock is exciting because it's going up doesn't mean it's worth buying. Price is what you pay, value is what you get. And if you're paying the wrong price, even for the right company, you will still lose money. So today, we're going to talk about Palantir. Yes, the artificial intelligence buzz is real. Yes, the hype is there. But the question we ask around here is always the same. What's it worth? You won't hear this kind of breakdown anywhere else on YouTube. Not from any of the hype guys, not from the price watchers, because they're focused on watching a ticker symbol go up and down. We're focused on what makes sense. So if you're tired of empty predictions and want to actually understand when Palantir becomes a smart buy, not just a popular one, you're in the right place. So let's talk about what really actually happened here with Palantir, because the stock has been on a wild ride. Back in 2022, Palantir got to $6 a share. I'm going to pat myself on the back here, so get ready. In early 21, Palantir was hitting $45 a share. And you guys all know that hypester on YouTube who was saying this thing was going to 500. And I came out and made a video and I said, I don't see it. I think it's worth $5 a share. That's what I'm going to be interested. Well, it got to 583. And I never pulled the trigger because it didn't hit 5. I regret that. I wish I could go back and change that. But that was $45 down to 583. And at that point, I understood the reason why, hey, it's 583, it's probably worth it here. But the same people who thought it was worth $6 a share and said it was awesome, now at $200 a share say this thing is even better. That's not investing. If you're the type of person who sees a stock go up 30x in a short period of time and the fundamentals haven't gone up 30x with it, they're not investing. Think about that for a second. AI wasn't the buzzword yet when it fell down to 6. And it looked like Palantir was just another overhyped story. Fast forward to October of 2025, it's a totally different world. The stock was gone from 6 to 190. Guys, that's over a 30x gain in under 3 years. So what has changed? 2 words, artificial intelligence. The company has grown tremendously, guys. In April 2023, Palantir launched something called the Artificial Intelligence Platform, or AIP. It made it easier for businesses, not just governments, to use Palantir's tech to analyze data and make decisions much faster with AI. Companies like Wendy's and American Airlines even started using it. Wendy's, revenue in their US commercial division at Palantir exploded, triple-digit growth. And this was all part of their plan, guys. If you go look at their annual statements, they talked about they were getting really large government contracts, but they were okay getting smaller commercial contracts to diversify their revenue. And I thought it was a great idea. By 2024, Palantir was the best performing stock in the entire S&P 500. It even joined the NASDAQ 100. That's like being invited to the grown-ups table. It opened the door to all the big institutional investors who have to buy index stocks. So when it gets added to an index, all these companies have to go buy that stock. Well, when all the companies or institutions are buying the stock, what happens to the stock price? Also in 2024, they pulled in $462 million in profit and had 40% margin on their operations. Guys, that's insane. And don't forget their core fundamental business, government contracts. Palantir didn't walk away from that. In fact, in August of 25, they locked in a $10 billion contract with the US Army. Now, is the stock still volatile? Absolutely. In fact, let me show you how volatile it is. In the last 1 month, it's basically even. Last 3 months, it's up 17%. Last 6 months, 80%. But look at these fluctuations, up and down, up and down. Now, there's been some recent selling, and valuation concerns are real. But the company is not the same as it was in 2022. It has grown up much better. It's profitable, it's diversified, and it's still got a lot of people fired up about where AI is going next. So now the question isn't, is Palantir exciting? It's, what price is Palantir a good value? And that is what we're going to figure out in a few minutes. And I'll show you the price I think is my fair value for Palantir. But in order to make good assumptions in our stock analyzer tool, we need to look at both the bull and bear cases for a company. If you're focused on just one of them, you're going to miss the entire story. Every company has a bull case, every company has a bear case. The question is, which one's heavier? Now look, a lot of people are excited about Palantir, and I get it. It's got a big story. Government contracts, AI, strong revenue growth, expanding into commercial. All the buzzwords are there. But let me do what other folks on YouTube refuse to do. Let's talk about the bear case, the risks, the stuff that gets ignored when the stock is flying high. Because remember, news follows the stock price. What I mean by that is, if the stock is up, the news that justifies that will come out, everything else will be buried. When the stock is down, the news that justifies that will come out, and the good news will be buried. Here's the truth. Every great company is not a great investment. It comes down to what you're paying. And right now, I believe that Palantir might be priced for perfection, but we'll get into that later here on the Stock Analyzer. Now, I will say this. Their CEO, Alex Karp, gives me the heebie-jeebies. That guy bothers me to no end. I'm not going to lie when I say he alone would be a reason I wouldn't buy Palantir. And yes, I do think it's important to understand that. I think the guy is absolutely wackadoo, and I think there's some questionable accounting things they're doing behind the scenes. But the good news is their free cash flow is always higher than their net income, which is a hard thing to fabricate. Right now, the PE ratio on Palantir, 606. Guys, I can understand if a company is a new business and they're starting out and they're just trying to get some investor money, et cetera. This is a $463 billion company that's been around for almost 20 years that generates $3.4 billion in revenue. And speaking of revenue, Microsoft sells for 12 times sales. For every dollar of sales they have, their market cap is $12 for it. Palantir is 135. I think Microsoft's overvalued and Palantir is selling for 12 times more. Keep in mind, Palantir has a lot more growth potential than Microsoft. But again, if it has higher growth potential, then why not pay 200 times sales? Why not 300 times sales? Why not 400 times sales? I think we'd agree that at a certain price, it doesn't make sense. The question is where. Now, if you told me Palantir was going to double its cash flow every year for the next 30 years, this is cheap. Because then the PE becomes 300 after 1 year, 150 after 2 years, 75, 37, and in year 5, it's selling for 18.5 times earnings. And you're still going to double every year for the next 25 more years. No brainer. But if I told you Palantir was going to grow its revenue 1% a year, this is insane. So again, bring up the statement. 1% a year, this is crazy. Double every year for the next 30 years, it's a screaming deal. Somewhere in between, it doesn't make sense. If that doesn't mean much to you, think about it this way. Imagine you bought a house and you had to wait 600 years to get your money back. You would think twice, right? Even with the house going up in value, even with your income going up in value, if you had to pay 600 times your earnings to get it, it would be a very, very tough pill to swallow. That's in a very basic form what these numbers are saying. Comparing to other tech giants like Microsoft, like I said, Google and Meta, Palantir's valuation looks extremely stretched. Analysts call this a bubble territory. Again, it has way more growth potential than Microsoft, Google, and Meta, so I understand it deserves a premium to the market. Now, remember, if analysts are calling this a bubble territory, it doesn't mean the company's bad. The internet was a bubble, but it wasn't because the internet itself was bad. It's because the companies within them were a little too euphoric. What they're saying now is that the stock price may be ahead of reality. The problem with hype-driven stocks is that when anything goes wrong, even a little, prices fall hard and they fall hard fast. And those problems can appear at any time. A new competitor shows up. Bad headline. Government contract doesn't renew. All of a sudden, the story shifts. Hell, it could just be people shifted their entire story on tech. And the most overpriced names will fall the hardest. That's the danger when expectations are so high. Another thing some analysts are pointing out is slower growth in Palantir's commercial business. Why? Well, Palantir's services aren't cheap. Some of these companies are pushing back on the price tag. And even though they're expanding, onboarding a new customer takes time. This isn't like selling someone a Netflix subscription where I just go to netflix.com, put in my credit card, and it's done. It's a complex, deep integration. And that friction can slow things down. Let's talk about something else most investors missed. Stock-based compensation. What that means is Palantir pays a lot of its employees in shares. That means that every single time they hire employees and those shares get activated, the shares hit the market and your slice of the pie gets smaller. That's called dilution. Let me give you an example. A company has 10 shares outstanding. You own one. You own 10% of the business. All of a sudden they bring 5 employees on, give them an extra share. Now instead of 10 shares, there's 15 shares because we added 5 more. You still own 1. So now instead of owning 1 out of 10 shares, you own 1 out of 15 shares. Your ownership went from 10% to 6.66. Yes, they have a buyback plan to help offset it, but it's still weight on the stock. And the buyback plan is buying shares of an expensive company selling for 600 times earnings. That's not exactly good use of capital. And finally, the bigger picture. What happens if the economy weakens? What happens if interest rates stay high? If the government cuts spending? That one's kind of funny, but it's a possibility. Palantir's business and its stock could take a hit. Just recently, there was a report about security problems in a military network Palantir was working on. Even if that's a one-off, it's the kind of headline that can start to shake confidence. Here's the bottom line. Palantir is a real business with real growth, a lot of growth, but the stock is priced for perfection. So don't just ask, is Palantir a good company? I want you to ask, is Palantir a good value right now? And what that means is the price below the value. We're going to look at these numbers in a minute and break that down. But let's talk about the bull case and the amazing potential Palantir has. While some analysts are sounding the alarm on Palantir's valuation, others are looking at this company and saying, this might be one of the most important AI businesses on the planet. Guys, I don't think they're wrong on that one. This definitely has that potential. At the heart of the argument is Palantir's AI platform, AIP. AIP is already being used by major corporations and governments around the world. Some folks in the industry are calling it the operational backbone of Western AI. Imagine that. These companies are using AIP to make real-time decisions with massive amounts of data, not just fancy dashboards. I'm talking about software that helps hospitals, airlines, and militaries operate more effectively. And it's not just powerful, it's sticky. Once it's built in, it is hard to rip out. And that kind of integration, that builds a moat, a real competitive advantage. And here's what's getting bulls excited. Commercial adoption is taking off. Palantir has been known for its work with the government, with defense contracts, intelligence work, long-term deals. But now that private sector is piling in. Yes, the growth has slowed a little bit, but they've seen triple-digit growth in commercial bookings. That means more major companies are signing on, and they're signing on fast. It's becoming essential infrastructure to these corporations. So now they've got government, they got commercial engines running, and that's the rare position to be in. That's what gives Palantir a huge advantage over everybody else. On top of that, you've got what investors call operating leverage. That's just a fancy way of saying that as Palantir grows, their costs don't rise nearly as fast. Guys, 80% gross margin. Every extra dollar they sell, 80% of it goes to the bottom line before taxes and overhead. That's huge. That will make their bottom line profit just keep going higher and higher and higher. Microsoft is at 68% on their gross margin, and their bottom line margin, I believe, is around 32%. So you can imagine the potential for Palantir here. This is how you grow margin. This is how you scale. And this is how you make a stock worth more over time. Not only are you growing the revenue by X%, you're growing the profit by even more. Some analysts think that Palantir could grow revenue by nearly 40% per year for the next 5 years. That's huge. If they keep hitting those numbers and their margins improve, then that high valuation starts to make a lot more sense. And here's one more piece that bulls love: execution. Guys, Palantir has consistently beat earnings estimates quarter after quarter after quarter. That means the team running this company isn't just talking a big game. They're delivering. Let me be clear though, no stock is a guarantee. And Palantir still carries risks. The biggest one might be valuation. But if you believe in the long-term potential of AI, if you think that governments and companies will need trusted software to manage critical data and operations, then Palantir could be the foundation of something much bigger. Now, let's walk you through how I analyze a stock and work to find the fair value and the price I'm watching that would get me to buy. Palantir could very well be the most amazing investment ever. Or it could be something to be cautious about. Or I could say be cautious about it and it still ends up being the best investment ever. We don't know the future. The goal here is to sit there and understand it. Now, most investors lose money because they try to pick winners. The best investors do the opposite. They eliminate the losers first. That's what we're doing here when we analyze a stock. We're here to look at it and say, why should we avoid this? So, one thing I love about this company, $1.7 billion in free cash flow last year versus $750 million in earnings. I love it when free cash flow is higher, and it's higher by over double. Net income in the last 5 years is a negative 136. Last year, 620 million. Guys, this company has more cash on hand. Look at this market cap versus enterprise value. They have more cash on hand than debt, so it's hard for a company like this to go bankrupt. Revenue growth, 25% a year for the last 3 years, 30% for the last 5 years. Acquisitions, $3 million. That's basically nothing. So they're growing all organically within themselves. That's absolutely incredible. Now, return on invested capital was negative for the last 5 years, but now it's positive at 5%, and I think it's going to go a lot higher. It's just a math thing at that point. Let's check out the 8 pillars here. Guys, cash flow is up over the last 5 years. Net income's up over the last 5 years. Revenue is up over the last 5 years. Debt is very low. Look at this. This is the dilution I was talking about. 35% more shares outstanding. Insanity. Yes, ROIC, not worried about that, but these valuations are nosebleed. That's tough. And again, that in and of itself doesn't tell me something's expensive. Yeah, 746 times last 5 year free cash flow. But remember, it's growing very quickly. Not only is the revenue growing at 40% a year, that means the profit can grow even faster. So let's go take a look at analyst estimates. Analysts have their profit going from 65 cents a share to $2.24 per share. Now, guys, this is just the earnings per share. This is the net income. We saw the cash flow was much greater. The cash flow is over double. That means they could be making $5 or $6 per share easily in 4 or 5 years. Put that at a 20 times multiple, that's a $100 to $120 stock. Well, that's my first red flag. Why? Well, that's for 4 or 5 years from now. The stock is currently at 180. Kind of a problem. Revenue growth, 48%, 37, 33, 45, 33. Big time revenue growth from $4 billion to $15 billion in the next 4 or 5 years. So guys, what I'm doing here is getting an idea of where the company is. I'm not trying to determine if I'm buying or not. The first thing I do when I find a company is I look at these high level things, and then I go to my stock analyzer tool. My goal is this. The stock analyzer tool tells me, Paul, look further or stop. You know, there's people out there who believe you have to fall in love with the story first. That's the bad idea. Understand the story quickly. Put some assumptions in. The stock's currently selling at 180. If all of a sudden the price is $10, why spend any more time? Move on. If the price is 1,000, yeah, spend some time because it's selling for 180 and you have it valued at 1,000. Go spend time as to why that is. And this all works together. So I'm doing a 10-year analysis. I'm going to do the first line, revenue growth, low, middle, and high assumptions. Guys, I'm going to call it 15, 25, and 35%. Remember, analysts think 40% a year for the next 5 years. Let's assume they do 30%. That's why I'm sitting there doing a little bit less because we're doing a 10-year analysis. Now, profit margin. This is where it's difficult because they haven't had the profit margin. I'm going to focus on free cash flow margin. They did 50% in the last year. Over a long period of time, free cash flow and net income will equate out. So I'm just going to treat them the same. Okay, even though they're not the same right now. I'm going to do 30, like Microsoft, 40, and 50%. Okay, remember they're having a hard time. Commercial growth has slowed, and I assume over time to get more and more revenue, they might have to decrease their margin a little bit. So I'm doing 30, 40, and 50%, the high level being where they did last year. Fair enough, in my opinion. And you might disagree with me. And if you're part of our community, go in here, put your own assumptions in. Now, what's the PE for this company 10 years from now? Well, guys, this is what I always tell people. The market average is 15 or 16 historically. You go higher from there for good companies, lower for bad companies. What makes a good company? Growing, high margins, high returns on capital, etc. Yes, this company's return on capital isn't good right now, but it'll get better. Yes, it's fast growing. And yes, it's got a great balance sheet. So I look at this saying it deserves higher than 15 or 16. Now, 10 years from now, it's a much more mature business. It's not going to have as much growth, but it'll still be a great business. So I'm going to do 18, 22, and 26. Still a premium to the market, but not insane. Okay? Finally, what's my desired return? Well, to find the intrinsic value, I always put in 9%. 9 to 10%, that matches the market. It's kind of like, hey, for this company to match the market, what does it have to sell for? Now keep in mind, for you personally at home, when you put your numbers in, don't put in 9%. You need margin of safety. You need to make a higher desired return. The more your return, the lower the price will be. But you need that margin of safety. Now, guys, 20, 25 years ago, I would have bought a hype stock like Palantir without even thinking about it. I wouldn't have run any numbers. I would have just saw a stock price go up. Somebody would told me to go buy it, and I would have absolutely bought it based on the story. Paul, they're changing everything. That's what I did back then. That wasn't investing. That was gambling. And that sounds like you. It was everybody at some point, even Warren Buffett. And that's exactly why we created Everything Money. We wanted to give the 19-year-old version of me the tools, the strategy, and the community that I never had. When you join EM, you're not just getting our powerful investing software and the super powerful stock analyzer tool that's used over 1 million times per year by our users. You're getting a foundation. We integrate you into the community by watching courses so that we all have the same foundation. We get you engaged in our community of like-minded investors who are all trying to level up their investing because you need the mindset, you need the support, along with the software and tools. Guys, this isn't for everyone. It's just for the right ones. So if you're committed to investing the right way, I encourage you to start a 7-day trial below. Click that link. We have limited spots each day. And if you're serious about investing, and that's the main point here, if you're serious about learning and investing for the long run, this is the place for you. And guys, we're very proud. 83% of the people who sign up for a 7-day trial end up taking the year-long program. That's how much they love it. So I hit the analyze button. The stock's currently at 180. This is why I'm apprehensive about Palantir. Low price of 17, high price of 170, middle price of 57. And before you go, I want to show you this. Let's change the growth rate. Let's change it from, let's go 25, 35, and 45% for the next 10 years. Let's go 40, 50, 60% profit margin. Let's go 20, 25, and 30 times. And guys, look at this. It's still expensive. Unreasonable assumptions up here that will be very, very, very nearly impossible to hit, and it's still expensive. So if you come to me and say, Paul, you don't get it. If you come to me and say the same person who said it was a great buy at 6, it's a great buy at 180, I'm sorry, you just don't get it. I'm going to add it to my watch list at $60 per share. That weight notifies me when it gets there. And you might be surprised how fast that might happen. And guess what? It might never happen, and I'm okay with that. What I'm okay with is avoiding stocks that are at the wrong price because something that I never even could have fathomed happening happened. Because if that's what you're relying on every single time, you're going to end up disappointed. Now, guys, earlier this year, I picked 7 of my own stocks that I own to go head-to-head with the so-called Magnificent 7. Click the video on your screen to see which 7 stocks I bought, why I bought them, and how they've stacked up. Guys, the results are going to surprise you. Thank you for your time.